Hey everybody, it's Jeff, and in this video I fully want to explain the GameStop saga. How has this stock gone up so much? Why has it gone up so much? And this whole Robinhood situation, or were they wrong? Are they good? Are they bad? I really want to dig into kind of what their problem is, at least through my point of view as a full-time trader. So let's jump right into it. First, I think it's important to ask why GameStop? Because if you can understand why this particular stock, then maybe that can help you find other ones of equal value that maybe have upside potential. Now, granted, this was the perfect storm in a lot of ways. I don't think this kind of return could be replicated, but let's dig into why this specific stock. And you have to go back maybe a month or two, and it really at the lows when GameStop was trading for $4, $5 a share, they actually had more cash on hand than the value of their stock. They were considered deep value. Now, just because they had the cash on hand, the reason why it was trading low and going lower, at least in the eyes of the short sellers, was they just were not making money. And the short sellers thought, yes, they had a lot of cash. Yes, there's other maybe positive attributes, but the short sellers believed eventually their business model would go to zero. And at this point, the Reddit followers took notice, just a few of them. One guy with the most popular one who kind of found this trade to begin with, who has a handle with deep value in it, essentially looks for stocks who are deeply undervalued. And he then posted on this Reddit site explaining the trade. Now, it took weeks before it actually started to go up in any meaningful way from the very first post. From there, shortly after he posted his, GameStop brings on a new board member, which kind of sparks some excitement. And actually, at that point, the stock finally started to trade higher on this news. Now, that even at that point, the price was only $10 to $17 a share. I think it jumped up to $17 or $18 a share on the news of the board member. The most important thing of all, though, is the shorts. Now, a short seller is essentially someone who sells what they don't own first with the intention of buying it back later at a lower price. In the stock market, this is allowed, amazingly, to allow you to sell what you don't own and bear the risk if you have to buy it at a higher price, but you also get the profit if you get to buy it at a lower price. Almost no other industry, no other hobby, no other place in this world can you sell what you don't own first and try and buy it back later, except for the stock market. And I'm sure this saga, now that DC has taken notice, will debate whether or not short selling should be allowed far into the future. But the fact is, short sellers held 130% afloat. What does that mean? If all the shares were totaled up for GameStop, they were short more than the entire total. And there really is no governing body that stops it at 100%. If you sell something you don't own, all you have to do is pay the borrowing cost. And these short sellers were at the lows, at its most shorted position, were short 130% afloat, which was unheard of. Tesla is another popular stock, and that short percentage is anywhere from 20 to 30% afloat. And you can see why GameStop was so dramatic. And at this point, the Reddit followers started posting on a fairly aggressive trader site called Wall Street Bets, where they started herding together. Now, this is another important question. How did it exactly go so high? There's really three main reasons. The first reason is herd buying. The power of all the Wall Street Bets crowd, all the Reddit crowd coming together at the same time. They started buying the stock that wasn't a big stock. This wouldn't work on an Apple where there's 20, 30, 40 times more shares available. And simply because, yes, there might have been a lot of retail traders, but in an Apple stock, there's just too many shares to make that kind of impact. So they all came together to buy, and the stock also happened to be a relatively small stock in comparison to the general stock market. And of course, that created a scenario where the shorts were covering and also then having to buy. So you had a double effect of shorts getting squeezed, having to buy on top of the herd buying as well. And then most importantly is this thing called options. And let me run in through a quick example because this is extremely powerful. And this is why Robinhood got in so much trouble, is because they allowed trading with options. This was a stock on January 22nd of 2021. You can see at the time, the market closed right at $65 a share. And you could see the overnight action. It traded all the way up to $130. On January 22nd, a $100 call was trading for $20 a share. Now, what does that mean? That gives you the right to buy the stock of GameStop at $100 a share. Now, the stock was 65. So why not just buy it at 65? Well, if you bought it at 65 and it went to zero, you're risking $65 a share. If you buy this 100 strike call for $20 a share and it goes to zero, you're risking 20. So one could argue that it takes less premium. You're risking 1/3 as much if it goes to zero and you're wrong. And if it goes higher, it has to exceed 100 for you to start making money, or really it needs to exceed 120 for you to start making money. Now, this is important because a lot of Robinhood traders love to buy calls instead of buy the stock because it allows you to leverage. For the same $65, you can now buy 3 calls as opposed to 1 share, so to speak. So this leverage is essentially fuel on the fire in terms of the herd buying. Now, what happens to the person who's selling that call, and this is where it really gets interesting. Let's say, for example, an entry trade, a retail guy at Robinhood buys 1 call. 1 call is equal to 100 shares of stock. So the retail buyer of this 100 strike call pays $20 to Robinhood. $20 times 100 shares is $2,000. And the thing is, Robinhood allows you to margin. So you might only have to put $1,000 up to buy this 100 strike call for $20 a share. So your leverage on top of leverage, it gets out of control. But the retail buyer buys a 100 strike call, pays $20 a share. The fund is the seller of this call because funds view this stock as essentially worthless. So in the fund's point of view, it'll never go above 100. They're collecting $20 a share. They're never going to have to worry about it going above $100. But they might hedge themselves by saying, okay, maybe I'll buy 10 shares of GameStop at 65 just as a hedge, just in case. And this is a popular trade. It's called delta hedging, where someone who sells a call that is worth 100 shares, they're not going to go out and buy 100 shares of the stock. They might only buy 10 or 15. Well, next thing you know, a few hours later, GameStop rallies to $80 a share. The fund gets a little more nervous now because he's essentially going to be short 100 shares at $100 at the $100 strike price. So he ends up having to buy another 20 shares. So as the market's going up, not only are retail buyers buying it, retail buyers are also buying calls, they're buying stock, and the people who are short these calls are also buying stock. It's just the perfect storm. And then a few moments later, it's back to $95 a share. The fund's having to buy more. This is what's called gamma risk. And this is the biggest reason why GameStop's able to rally 70% in a day. This is not normal. This doesn't happen usually where stocks rally like this. Now, I want to get to an important question. Is Robinhood good or bad? And this is highly debated in all of media right now, and you're getting a lot of both sides. And I kind of want to go through it. How does Robinhood actually make money? And this is the crux of everyone's argument. And they sell your order flow to hedge funds. So what does that mean? If you go in and say, hey, I'm going to buy 10 shares of GameStop, they actually will sell that 10 shares. Instead of sending it to the New York Stock Exchange or to NASDAQ to directly buy it, they actually sell it to a hedge fund. Now, why would a hedge fund pay for that? The hedge fund has set up an algorithm that says, if you're going to buy 10 shares of GameStop at 65, and maybe you say, I'm going to place a market order, so just buy it at whatever price, the hedge fund, milliseconds before, will buy it first, push the market up just a fraction of a cent or a penny or two, and then sell it to you. A hedge fund essentially makes money on every single trade that Robinhood sends in. Now, Robinhood in most normal markets will say, yes, you got 0 commission, and maybe these hedge funds are scalping a penny or two off every share, but that's not a lot of money in the grand scheme of things. It's nothing to worry about, and that's probably true. And of course, where this all came to head is the very difficult position that Robinhood is in. They're kind of stuck between servicing the retail trader. They need to make sure the retail traders are happy, but they're also servicing the hedge fund. and they can't risk pissing off the retail trader because the retail trader will go away, but they can't risk pissing off the hedge fund because the hedge fund won't buy their orders. Robinhood can't make money if they aren't selling those orders to the hedge fund. The hedge fund right now is not liking this idea of the retail trader essentially winning. And it's put Robinhood in an impossible position. And what makes matters even worse is Robinhood lets you trade on margin. And this margin exposure essentially at Robinhood has put them in a perilous position where they're having to settle up with other exchanges every single night. And the real reason I think that they stopped allowing buy orders on GameStop is because there's so much margin exposure. Everybody's so leveraged that at that time, the market was going up and down. People weren't all profitable on their trades. And if they let you trade on margin, you have the potential to go negative on your account. There's some discussion at the moment that Robinhood might have been insolvent for a brief period of time. They raised, I think, $1 billion or $2 billion almost overnight because they were insolvent at some point. At least that is the speculation. I don't know that for sure. Now, what does that mean? Should you trade on Robinhood? Now, personally, I do not. And if I had money on Robinhood, I would probably not feel good about that. Now, this is my own personal opinion. This is not financial advice. Please don't take it that way. None of this video is financial advice. But if it were me, I'd probably do my best to get the money off Robinhood as fast as humanly possible. Now, they did raise money, and I'm sure they're solvent today. But that doesn't mean that this could last and they might be good forever. So I'd just be very careful if you're trading on Robinhood. So that kind of gets me to my final thoughts. And as a trader who's been trading full time for 12 years, the reason I want to say trading is not easy is because I've had 35 phone calls in the last 72 hours of people who've never traded in their life and they think trading is easy. It is not. Be very careful with your money. And also, markets are dangerously high. There's a lot of signs. I've been through a fair amount of market crashes, and they all have these signs, such as when everybody starts talking about the market, how easy it is. When you hear on the Today shows talking about the market, that is usually a dangerous sign. And we are at that moment right now. And now is not the time to trade with leverage. If you are doing that, I would highly recommend you be very careful. So that is all I have. I wanted to share this video with you. If you could, please consider subscribing to my channel. And thank you for watching. Take care.